Right, today is the final lecture for you. This is statutory provision. Mainly, we call it as tax administration part. Basically, this is one of the key area you need to be focused when you are dealing with tax matters with IRD. Basically, then this is the compliance requirement. How you are going to file the returns, and what are the penal provision, how to appeal, what kind of assessment there are. Then so the basic things we are going to discuss here, not in detail. Basic things we will go through with the learning outcome as well. These are the learning outcomes. So under that we will go through with the areas which are important for you. So uh, basically the first chapter is the payment of tax. Then what kind of payments there are. So there are three kind of payment. If you can see, the withholding tax is one area, and the installment is another area, and the assessment basis, then the department will issue assessment, then you have to pay that taxes also. So there are three kind of payment. Basically we are focusing here. The first one is installment. The installment tax, anyway, the withholding tax is, you know, that the withholding requirement we discussed when we are reading under section 83, 84, 85, under 88 up to. So we discussed the withholding things and the shared summary with you, I think. So then here we are mainly focusing the installment payment. What kind of installment you will see in the tax perspective. Section 90, if you can turn into section 90 of the Inner Revenue Act, it says it's identify taxpayer as an installment payer normally, and the liable to pay, they are liable to pay income tax in quarterly installment basis. The 4 quarters, the highlighting word is 4 quarterly installment. So then they are liable to pay for quarterly installment based on the previous year details. So then they are paying quarterly installment basis uh, based on the prior year or else current year. Can we go prior year? Because I discuss, I think no, not this class. I discuss the how you are going to pay the income tax current year basis or the prior year basis. Can anyone here let me know? Do we have current year basis, or do we have still have prior year basis? Do you have still prior year basis? Can we apply for prior year basis for quarterly payment when you are making taxes quarterly? Let me share the screen first. I will share the screen, the whiteboard, and I will draw the line here. Here, if you can let me draw the for two period. Basically, your year of assessment is, in the year of assessment for your exam purpose is, you know, that is 1920. But then let me explain the 1819 as well, and the 19, right here the 1920, right, and the 1920. If you can see here, I will type here as 2019-20, and here is year of assessment 2018-19. So under this, if we can, then what we need to do is let's say the prior year 1819 tax liability is 100 million. Then the previous law, under the previous law, we did was, in order to avoid penalties and all, what you need to do is you can divide whatever the prior year tax liability and pay the taxes 1/4 of that. Then let's say for this period, this particular period, let's say you have tax liability is 100 million. Let's say you have 100 million tax liability. Then previously what the practice was, you paid the taxes based on the prior year by dividing 4, right? Then the each 4 quarters they paid quarterly installment. Then that is why we call it as quarterly installment. So if I divided this year into 4 quarters, we need to pay taxes quarterly. So I can draw this quarterly installment likewise the 4 quarters. Here the Q1 and Q2, here Q3, Q4 and Q4, right? Then these 4 quarters, what we did was previously, forget about this year of assessment, I will erase this year of assessment. Under the previous law, what you did was, in the tax petitioners, you divided this one into 4, the prior year tax liability by 4, and they paid taxes each quarter equally. In the 25 million this quarter, and this quarter again 25 million, and again this quarter 25 million, and this quarter is again 25 million. Likewise, they paid quarterly installment. We call it as, this is first quarter, this is second quarter, this is third quarter, this is fourth quarter. Likewise, we paid quarterly installment. So this was the practice, right? Then later we know that, or we all know that, once the year of assessment is finalized, then after the audited entries you are passing and all, then finally we realize that the tax liability, we assume that based on prior year we paid, no. Then if there is a additional amount after audited accounts, we realize that then we need to pay balance amount. If let's say, if this quarter, let's after the auditing is finalized, right, after this year, after the audit is finalized, they realize that this is 600 million, right? Then sorry, this is after the finalizing audit, like this is 100 no. Then after finalizing the audit and finalize your tax computation as well, after the audited financial statement, AFS, the tax liabilities, let's say tax liabilities maybe 120 million. Then you have to pay that balance 120. Actually, when you need to pay balance 120? Can anyone here let me know when we need to pay balance 1? So this is also in the previous law, which was the date. Basically, later they have specifically said that if there are any balance payment there, they allow us to make the payment later. So what we did was, we identified whatever the amount as a liability, and the quarterly paid amount, they deduct whatever the amount they paid quarterly. Then if there are any balance, am I audible enough? Yeah, raining. And I know whether I am audible enough. Hello. Can you hear me? No one can hear, right? Right. This uh, balance 20 million. Balance payment is going to do is balance payment you need to pay the date they have granted. This date anyway we will discuss. This date is, can anyone guess and give the answer for what is when we need to pay this balance 20 million after the year of assessment? Can anyone hear? Right. Yes, exactly. Then this is 30th September. Then the 30th September is the last day for the payment. Then the whatever the year. For your purpose, now just think about, you don't have quarterly installment basis and prior year. Then from the year of assessment 1920 onward, you have to calculate on current year basis. You have to calculate on current year basis. No prior year uh, detail you can't take it, because you have to take the figures as per the uh, management accounts or quarterly accounts which you are preparing. Basically, whatever the practice is currently in the industry, they always go with the prior year detail and just think about the market fluctuation. Then if they have the market increase of sales, then they will increase that percentage in the tax liability and they will pay quarterly. So then if there is, due to COVID situation, if they see any market decrease, their sales decrease, then they will adjust according to the prior tax liability and pay quarterly installment. That's what's the happening in the practical scenario. But in the tax perspective, you have to ascertain the current year tax liability based on the actual results. So, but in the practice, we can't do it because most of the companies, they are not preparing the quarterly or monthly financial statement other than few bank and finance companies. So therefore, what they need to do is basically they can go with the prior year and with some modification of the amount. Then I will explain this in detail again. See, now this is your year of assessment. Think about this. This is your year of assessment as this is your year of assessment 1920, right? Then this is these are, we take it as actual. Let's forget about this 1/4 scenario. Then I will mention this one as actual, right? Actual detail figures or the approximate, right? Approximate, approximate figures, right? Or 25 million they paid. Then after finalizing audit, they realize then there is a payment. Then we have option. Still we have that option as well in the current system. Then if there is a balance payment, then we can go with that, can pay the balance 30th September. That option in the previous law as well as this law also we have. That option we have. So then in your year of assessment, if you consider this as your year of assessment, 2020 September, if you are in tax period or accountancy period, then the clients, they have asked sometime, please finish the audit and complete the audit because we need to pay final, we need to ascertain the tax liability, whether this is final, therefore we need to pay this one and complete the audited account. So that kind of things you might sometime come across. Even now you might facing some difficulties because November 30th is the due date for return filing. We'll discuss that one little later. So this is the 30th September final payment scenario. Then quarterly we need to ascertain the figures, and if after the audit finalized, if it is liability change, then the balance amount we can pay it. Balance 20 we can pay it in 30th September or no before 30th September. So this is the quarterly payment. That is how the payment is going. But let me clear this one again, and I will draw the one is quarterly payment due date, right? I will explain here to you the quarterly payment due date. Also, if you want to explain this one quickly, send me a message. Otherwise, I can skip this part. The quarterly payment, if your year of assessment is 1920, then you you are paying quarterly taxes. You are paying quarterly taxes, right? Each quarter. Then, if I can divide these quarters, segregated this quarter, let's say this is. Then can anyone here let me know when we need to pay this first quarter? You know the first quarter in the sense for your year of assessment, first quarter is, and for your year of assessment 2019-20. In this case, first quarter begins with April to, you know that is very well, right? Then the April is the year starting date, 1st of April 2019. So then the last date is March 2020. The year. So then the April to June, first quarter is when it is due. Then when it is due, the first quarter tax payment. Let's say in this quarter, this period, let's say this period, then when the income tax payment should be made by them. Can anyone tell me when they need to pay income for the first quarter? Yes, of course. Uh, then the first quarter is you need to make the payment is August 15th. Exactly. As you correctly said, it is August 15th. Then how we are taking this August 15 means August 15 means the 45 days, basically 1.5 month. 1.5 month. Then if it is January, April, May, June, not July, August 15, the 1.5 month. If then that day they need to make the payment. On that day they need to make the payment. If you take this here, Then you need to make the payment in this day. In this day, let's say the amount they have considered is 25 million. Then we tell this is 25 million for this quarter. 25 million they need to pay on this day. This is how you are going to make quarterly. Likewise, likewise, I am not going to draw each and every quarter here. Likewise, then the next one is, can anyone tell me here the second quarter? If the second quarter is, let's say quarter 2, when is the due date? Then third quarter, when is the due date? Then the fourth quarter, when is the due date? For the payment, can anyone here type and send me, or that you can loudly answer quickly, then I can go quickly, finish it. What are the due dates for quarterly payment? Then tell me the when is the due dates. The engagement is must, this kind of uh, when we are doing this kind of lecturing, the student engagement is really needed. Otherwise, we also feel boring. You also feel boring. Then the final outcome is 0. So uh, then, yeah, I'm getting now answers. We have then each quarter 25 million. Let's say they have ascertained the actual tax liability for each quarter 5 million. Then each quarter they have to pay. Then the next quarter due date is, as you correctly said, we got answers. Mm, yeah, I'm getting answers now. Then the April, May, June, we know that August 15. July, August, September, November 15. Then the November 15, if you are in tax field, keep in mind this date. Now you have to pay second installment. Second installment which is due on November 15. Today is November 3rd. November 15 is another due date, right? November 15. So then the third installment when it is due. Third quarter when it is due. Third quarter it is due on October, November, December is February 15. As you correctly said, February 25 million also they need to pay. Then the January to March. Jan to March is May 15. May 15. Balance for your year of assessment. Then if you can see each year of assessment, uh, each quarters they need to pay taxes quarterly. This is, we call it as first installment, then the second installment, and the third installment, and the fourth installment. We call it as first installment here, installment, and second installment, and third installment, and the here the fourth installment. Right? Then here, if you can see, you are paying quarterly, fourth installment, after fourth installment, right? Yes. Then the fourth installment is from unit level. Fourth installment is May 15. Fourth installment is May 15, right? Uh, then these are the quarterly payments you need to do in order to avoid income tax penalty. Then the installment perspective, the penalty is 10%. Then we will discuss that one little later. In the slide, I will quickly go through whatever important points I am going to discuss in the whiteboard. Then, then here this is quarterly installment based on the actual liability. Soon after you realize that after audited accounts finalized, then you realize that the audited accounts, after the audited accounts, then the amounts is little different. After the audited account. The liabilities, tax liabilities, after the audited account, tax liabilities, now you realize little different. Then it is now you realize that 120. You ask tax same liability, then it is 120. But quarterly installment paid, quarterly installment paid, how much you pay quarterly? You know that 100, 25 million each. Then the 100. Then there is a balance tax payable. Balance payable, like I discussed this. Balance tax payable 20 million. You need to pay it on or before September 30. Then I'm going to draw that one as well. Here there is a balance tax payment. In this balance, they need to pay. They have time. September 30. When there is a green signal is September 30th, you can pay balance for your year of assessment, right? Then the 2020, then you can pay this balance 20 million. Then you are clear. Now you know the quarterly payment and the final payment requirement as well. So, and then this is the payment procedure. Right. The one student is telling me. Let me use some gadget, whether it's work or not. Am I audible enough now? Am I audible enough? Can you hear me now? Can you hear me? Yeah, okay. Quite okay, right. Uh, right. Uh, right, we'll proceed. So then you know that quarterly payment is now fine. Then there is another compliance requirement when it's taken into the year of assessment 1920. what it is. We are near to that. It is return, income tax return. When it is due? Can anyone guess me? Guess when the income tax return is due. I think everyone must know this one. The when the income tax return as accountant students, you must know this one. The when the income tax return is due. Yes, I'm getting answers. Yeah, exactly. Yeah, as you very correctly said, return of income, income tax return, income tax return, income tax return, which is due November 30th, 2020. Then the November 30th, there are some news going on. They will extend the return filing anyway. They will extend that one, but try to file the as statutory due date. Don't expect any extension. If you can finalize your tax computation and together with audited accounts, then try to comply with the statutory deadline. What you need to know is here, if you not file the due date within the due date, basically November 30th is the statutory deadline. Then due to this COVID situation this year, they will extend this time, definitely. uh, I heard about they are going to extend the pay until February 2021. There are some through 31st March 2021. Then there are so many things. Anyway, online filing will open till March 31st, 2021. So those kind of arrangements are going on. But if you can finalize your purchasing, then better to comply with the exact date, because if you are filing late, if you are filing late, then definitely 1 second. Right. Sorry. Then this is the final deadline. What we discussed was you can comply with this one. These are statutory deadline. Then this is the year of assessment 1920. But don't confuse with the 1819. 1819 I will share with you 1819 what was happened. There was a 5% uplift amount, and if you refer some past papers in C Sri Lanka or any other things, then there is a year of assessment 1819. The first year under new law, there was a provision. I will explain. Let me open that one as well. Uh, Uh, right. Anyway, it's not saved. Right. Anyway, I'll explain that one as well in the whiteboard. The previous law, previous year of assessment, if you referring to the 1890, first year of assessment under new law, that was basically the 5% uplift of the prior year. That one, no need to remember for this year of assessment because it is relating to prior year. Then if you want to know about that 5% uplift month and the quarterly payment, then the previous law was, I will quickly draw that one as well. And because it is not necessary for your general understanding purpose, if you're doing some past papers in the previous years, don't do the past papers before 1890, any past papers, because the year of assessment is changed, because then you will face some difficulties to represent any past papers in this exam or the any other professional exam. So for tax perspective, tax is continuously changing. So therefore, try to get the theories in the session we discuss, because the everything is applicable for your year of assessment is being discussing here. So year of assessment 2018-19. 18-19, what was we did is basically because it was the first year of assessment, if you can with under new law, then the this we are very new to that law. Then we didn't have time to compute the tax liability even under the new act, new provision. Soon after come into the new law with the effective from 1st April 2018. Then what they introduced was whatever the prior year tax liability. They said that whatever the 17-18 tax liability, they said that the 100 million, let's say 100 million was the tax liability. Then they said that then you can treat that 100 million as it is. Then 100 million as it is, and you need to do little adjustment. What is the adjustment? 5% upliftment. The 5% you need to add. Whatever the thing was, they ask you to add 5%. Right? 5%. Then let's say this is about is 200. Here this is 200 million. Here also 200 million. Then the 10, right? Likewise the 5% upliftment. So then the with 5% upliftment, what they ask us to compute is, as per the provision, 210 is the amount. 210 is the amount. You need to divide by 4, and they ask us to pay quarterly installment based on the prior year with 5% upliftment. Then if you can divide this 210 then by 4, what is the amount you are getting exactly? If you can divide 210 by 4, 50.5, right? Am I correct? 2.5. Then what they want to do is, then they require to pay quarterly 50.5 each for this quarter. Then the year of assessment 1920 onward, what you need to do is the you can't go this 5% upliftment. Don't apply this 5% upliftment. This 5% only for the year of assessment. This 5% only for the year of assessment. This year of assessment only for the 18-19 year of assessment. Only for the 18-19 year of assessment. Right? Don't apply this 5% anymore because this is not the case under year of assessment 1920. 1920, what I did was is correct. You can use whatever the things discussed previous whiteboard, right? You can't do the 5% uplift here while referring any other past year data. Don't use that one because now you can't go the 5% upliftment based on the prior year. Here the last year was the due to law implemented suddenly, they can't compute the tax liability according to the new provision because new provision was new, no? Everyone not aware very well about the new provisions and all. So what they did was basically they asked them to increase 5% upliftment and divided by 4 and pay each quarter for the year of assessment 1920 and the final payment also they are. So then let in the year of assessment 1920 onward, no 5% upliftment. Don't apply that one. That's what I want to explain to you. So, right? No 5% upliftment in the year of assessment. No 5% to prior year. When you determining year of assessment 1920 quarterly installment. Right? Installment. Right. Then this is you need to keep it mind. Right? This is important. Right. I will move to the now again to the slide. Right. Now you know the basic things, quarterly payment and all. Then there is one document was recently introduced with effective from April 1st, 2018 with the New Inland Revenue Act, Statement of Estimate Tax Payable. This was a new thing introduced in the Inland Revenue under Section 91. The set form, we call it as the pet name is set. Pet name is set. Statement of Estimate Income Tax Payable. So under this, what you need to do is you need to in the beginning of the year, the first quarter, you need to submit the set form. So let me share the whiteboard whether I can import that previous one. There is no option, right? Let's save this one and clear all. Right? Then what you need to do is you need to file the set form what I drawn in the quarter, each quarter. Then likewise you need to do the drawing. This is quarter, let's say 4 quarters, right? This is 4 quarters, right? Then what you need to do is how and when we need to file the set form. Can anyone here tell me When we need to file the set form, statement of estimate income tax, you need to know that one. This is your year of assessment. 19. Then the when you need to file the set form. When you need to file the set form. Can anyone hear? Yeah, I got one answer, but it is wrong. The year starting is here, right? Starting is here, then the ending here, right? The starting and then the each year we have 4 quarters. Then what you need to do is the first quarter, because these things then while taking your answers I can see then the first quarter. Yeah, there are some students giving correct answers as well. Then 25 million, let's say, this quarter, like we did. Exactly. There are some students. Let's say each quarter you have tax liability and you need to pay, right? Each quarter. Then what you need to do is basically, let's say 25 million each, you need to assess the tax liability, estimate the tax liability. First of all, you need to estimate the tax liability. Estimate tax liability for the year of assessment. For the year of assessment, let's say 100 million, you estimate as a tax liability for the year of assessment 1920. Then this estimated tax liability, what you need to do is you need to pay quarterly. This is the estimated tax liability. Then quarterly installment, quarterly installment, quarterly installment is 25 million, right? 25 million each, because 100 divided by 4, right? Then this estimated tax liability, you realize that 100 this amount, then what you need to do is for this quarter, then when is the payment due date? Payment is due on August 15. August 15 is the payment due date. Then you know that August 15 is the payment due date. Then you need to pay 25 million. Then you estimated this as a 25 million, and therefore based on this estimated amount, what you need to do is you make the payment, right, for this quarter. And also not only payment, there is additional return is called set, which is also due on the August 15, which is called set, which is also due on August 15. So what you need to do is, this is the set form you need to file the Inland Revenue Department. We call it as set, statement of estimate income tax payable. So this is set form. Then whatever the tax liability for the year, you need to declare here 100 million. 100 million. Then this is the estimate liability. You will pay quarterly 25 million. You just need to declare 100 million as it is. If you have ESC and tax credit, so and so on, you can declare those things as well. Let me share the IRD website as well with you in order to emphasize this, what kind of return is that is, right? Let me share the IRD website here, right? If you can go to download and forms and return, then you can see there statement of income tax payable for the year of assessment 1920. Statement of estimate income tax payable, because 2021 also there, because I will just open the 1921 for as your year of assessment. So this is the form, set form, estimated income tax. It is not the big one, two-page return. You just need to declare. This is the date as we discussed. August 15 is the due date for your year of assessment 1920. This was the due date. Then you just need to set here the statement type is original statement, whether it is revised. This is original. Then the original, and the corporate income tax is company. Then they don't have employment, they have business income. If they have investment, if they have any other income, they need to declare, and the total assessable income. Then they can deduct qualifying payment and relief. Then the taxable income and the estimate tax liability by applying the rate. Then if there are any foreign tax credit, they can take it that one, and the estimate tax payable for the year, estimated tax payable. Then you will do is quarterly you are making the payment. Then for this they have published a guide as well. Then these are the additional reading for you. So if you can refer this guide, though so many instruction, I'm not going to discuss in detail due to time constraint. They see the installment due date, everything is there, right? How you need to make the payment, period codes, everything. So the penalty, late payment penalty, and the interest, everything, right? And in the case of here, how to calculate. Then this formula also given. We'll discuss a little later this thing. And they have uploaded few calculations as well for individual perspective, because here you can take this as example and you can do for your company perspective, right? So I will share the whiteboard again. This is the set form you need to submit, right? You need to submit set form by declaring 100 million is the tax liability. Then you will pay each quarter 25 each. Then the 25 million. Then the 1st of January or the 1st of February, you realize that 1st of February you realize that the tax liability has decreased due to this COVID situation, right? 1st of February. Then significantly, you were the export-oriented company. Then the significantly reduce the income. Then what you need to do is you realize that then if it is 1st of February, when we can adjust that one. Then the first quarter you paid, second quarter you paid, then you are on third quarter. Then the August 15, and November 15, and February 15 is the next one. But February 1st, they realized that their turnover is going to significantly decrease. Even the March, they don't have any turnover. They realized. Then what do you need to do is, then the third quarter is due on, third quarter, third quarter when it is due on. Can anyone tell me? When the third quarter is due? Right, exactly, February 15. February 15. Then because February 1st they realize now. February 1st, 15. Then they realize, they are wondering how much is they are going to pay. Then they realize then their tax liability is now getting decreased to 80 million, not the 100 million. Then the tax liability is now, they realize that tax liability is now due to COVID, I will draw that one in this as well. Due to COVID situation, due to COVID-19, due to COVID-19, company where the tax liability equal 80 million. On February 1st, kind of things you will get, right? So the patriarchal questions, right? Then you don't argue that COVID is came and impact was later, but let's say this is February, they realize, and March they don't have even sale. February, because from the January beginning, February 1st they realize, then the March they don't have even turnover. So then can anyone tell me what was the quarterly installment now? How to compute? What is the quarterly installment now and how to compute? Then yes, then exactly, then you need to realize the amount, then how to calculate that one. What is the amount you are going to make the payment? What amount you are going to make? Yes, exactly. What you need to do is you need to submit a revised set. You need to submit a revised set. Revised set. Revised set. Declaring the turnover tax liability as 80 million. 80 million. Then the calculation is you need to do like this. The calculation, I will draw this arrow, and the calculation you need to do. Then the previous liability was 100. Then the initial liability was 100. Original, let's say original tax liability is 100. Original tax liability is 100. sorry. Right. Here the original tax liability was 100. Then what you can do is you can deduct whatever the amount you paid. Right. You can deduct whatever the amount you paid is 50 million up to 2 quarters. Right. Then you paid first quarter 25 million and the second quarter you paid. Then the balance amount is how much? The 50. But what is the now revised liability? Then the revised liability is revised tax liability is now 80. Earlier was balance you need to pay 50. You were required to pay as per the original 100. Balance you were required to pay 50 million and 25 each for next 2 quarters. But due to this revision, revised revised tax liabilities now it is 100 million, right? Is 30 million. Now 30 million. Then how much you need to pay in this February 15? Can anyone tell me how much is this amount? Then this divided by into 2 is 15 million. 15 million you need to pay here. This is third quarter, third installment, and the fourth installment also the same. Fourth installment also the same, right? And this is how you need to analyze the scenarios. And then this quarter you will pay 15 million, and this quarter also you need to pay 15 million, right? Then the revised set also need to be filed on or before February 15, right? On or before February 15. So then if I can share the screen, ERD website, here the set, original set, if you are filing the original, what you need was this is you tick original. Then if you are submitting the revised one, you need to tick here revise, and you need to amend the date. You can cut off this date, due date as February 15 2020, and you need to change the detail accordingly and submit the revised set. That is how you need to do in Pactrix. So then the theory part of installment and the quarter installment we discuss everything. So here now we'll move to the slide again and quickly go through the balance part. We have 1 hour remaining. This is set we discuss, right? We are not going to discuss. This is quarterly installment, and the how to calculate quarterly installment is the one area you need to be aware. This is section 90/3, subsection 3, sorry, 90 subsection 3. In that quarterly installment, you need to calculate quarterly installment by using this formula. So in this formula, if you can refer, this is quite better than if you can remember, this is estimate income tax payable. Then the second quarter installment, if you paid first quarter, what we did was we deduct this 50. Then the withholding tax, if there are any, you can do. And the remaining installment, what we did was in the calculation in the whiteboard, the remaining installment was here 2 quarters, right? Here the 2 quarters remaining, right? Remaining 2 quarters. The whatever the installment we paid, we deducted here, right? Then the balance amount, if you have withholding, you can adjust the withholding here as well. If you have withholding also, if you get withholding, you can deduct withholding as well. If it is withholding also there, right? You can adjust and deduct the remaining number of installment. Here the 2 is, if you want to know the 2, where the what is 2 is the remaining number of installment. 2 is remaining number of installment, right? Remaining number of installment, right? Now you're clear, right? So this is the formula what you need to keep in mind. And here again the estimate tax can be calculated as follows. The current year profit, basically estimate on the current year profit, what we discussed, those things. Then the estimate tax payable based on the previous year tax liability increased by 5% uplift. This is clearly which was applicable only the year of assessment 18-19, not for your year of assessment, right? Here the application is for you is a current year profit. Then the practically, I explained that practically what we are doing is basically prior year liability, we consider that, and the market fluctuation based on the situation, their sales increase and decrease based on the fluctuation. Then they decide and realize, then they will adjust accordingly the current year tax liability. So that's kind of practice is going anyway, because the most of the bank and finance company, they are preparing monthly or quarterly financials. So for submission, the central bank regulation and the SEC requirement, that kind of companies only. Most of the companies, they are not doing that monthly or quarterly financial statement. Therefore, what they do is basically prior year, they go to the prior year and adjust according to the current year and pay quarterly. So that is even then they can't significantly reduce that amount, because they can't do this one. They can't go that way, but they can, let's say last year liability is 100 million. You can't significantly reduce if you don't have any justification. Let's say last year 100 million, this year 20 million, you approximately take it 20 million, then the 80% reduction, then you need to have justifiable reason to say that that 20 million is because of this, due to COVID situation, export oriented country, we don't have export this year. So that kind of things, if you have, you can significantly reduce. So then the next one is installment payment and tax credit, such as withholding on payment income, service fees, rent, etc. The installment paid and tax credit. Then you can deduct tax credit such as withholding on employment income, service fees, rent, etc. could be deducted in the installment payment. As per the formula. Here the withholding tax part, right? Withholding tax part. And the withholding on employment, service fee, etc. rent income. The credit employment is not coming if you are doing the company perspective, right? The credit available for the year of assessment, for the being the year of assessment up to the date of installment be payable. So the whatever the amount is available based on the detail. If you have rent income, then the withholding has deducted the withholding agent, they have deducted, then you have to have a certificate in order to deduct. But 1st of January onward, January 2020 onward, you don't have withholding tax lot, because the withholding they removed and they make the withholding as optional. even the salary, interest, rent, everything, they make that as optional. Then if you opt to that option, then you might have a withholding tax on January to March quarter. If not, you have only for the 3 quarters withholding tax. So keep in mind that the ESC is paid before the installment could be deducted from the installment payment. ESC paid before the installment could be deducted, installment payment, and pay the balance. Then the ESC also you can take as a credit when you are making the installment payment. So the installment tax so calculated, this remain in force the whole year of assessment. If the liabilities increase or decrease, we discuss revised set. Revised set need to be filed if it is increase or decrease. Then we discuss the decrease part. The 80 million, the initially 100 was the amount. Now we discuss 80 million. If it is increased the other way around, that 120, when it's become 120, because they are a pharmacy company, due to COVID situation, they increase their sanitizer, whatever the product. If they have more sales on that, then they have more profits. So under that circumstances, you might have income increase, they have to adjust the tax accordingly. So the most of the company in practice they do is they adjust this amount as a final payment. It is not the recommended way, but they are doing that way. So here the question, if they here is another bullet point is income tax rate current year less than, this is I discussed that one. Then the here the ABC company you have to have practice this one. Then can you do this one and answer in the WhatsApp this group chat? ABC has estimated their tax liability for the year of assessment 1920 is 900,000. ABC has paid 225 for the first installment, and the withholding tax credit up to 30th September is 45. Then the calculate the second installment, second self-assessment payment. The due dates accordingly stated. Then you can do this one, because you can quickly do this one and take a screenshot of this, and you can quickly do. Due to time frame, I will move to next one. If you really want this answer, let me know, then I will share the answer. Right? Here the tax assessment, tax payable on assessment, section 84. Then the gain on realization of investment assets should be paid within 1 month after the tax payable. Should be paid 1 month after the date of realization, date of sale. If it is capital asset, then what they need to do is capital gain tax they need to pay on or before 1 month after the date of realization. Then the any balance payable, again income tax, we discuss this one as well. We'll quickly move. Then the 6 month after end of the year of assessment, that is September 30th. Then here the summary. Then the final payment, 30th September. Right? Here the return filing, when the return is due. Basically, return is due on November 30th. This one also we discuss. November 30th is the return due. September 30th is the final payment. Return is due November 30th. So then furnishing return. Do everyone need to file a return? Here is the answer. The return should be furnished and contain in the particular as specified by the CGIR. They may be schedules and any other requested document. As per the section 94 of the Inland Revenue Act, the return of income shall not be required if the resident individual, not the company, who has no tax payable, no tax payable, who has not tax payable as per the section 94. Then those tax payable under for the year state exclusively for the income for the employment only. But this was applicable up to the year, up to the date of 31st December 2019. But for your year of assessment, this is not valid. The individual, if the salary is exceeding 250,000, Inland Revenue Department ask them to open a tax file with Inland Revenue Department and pay the taxes. Whatever the taxes deducted April to December, they can take that credit, and the balance payable, if any, they were required to pay September 30th, and the return also for them is due on 30th November. So the individuals who were liable to who are above the threshold 250,000 per month, they definitely should have a file. They have to open a file and they have to maintain that and need to pay taxes quarterly. Then they can go under the optional scheme. They can ask employee to deduct that their taxes on the employment income. But even they ask from the employees to deduct, they have to file the tax return. They have to file a tax return, and if they have any additional income, they have to pay quarterly, other than the employment income. The intention was to introduce this 250,000 threshold. Is most of the individual, if they earning more than 250,000, they must have additional income sources. That was the intention. Then the government introduced everyone, those who are having 250,000 employment income, definitely they must have to have a file. So this one is no more applicable. This is the applicable one. Then the non-resident person who has no tax payable for the year. Then the non-resident person, no tax payable. Then the registration part is, I'm not going to very much touch this one. The registration, you need to register. Normally every person who liable to register. Then they, for the year of assessment who has not already been registered, Commissioner General shall register with the Commissioner General not later than 30 days after end of the year of assessment. The basis year, that year means the year of assessment. So this one, and also for the minister, the finance minister with the concern, the Commissioner General may additional case. Minister can ask someone to register. Then the minister can ask, you go and register. The minister can inform to Commissioner General, please register this person. They have this much of income. Minister has power. So that kind of arrangement also there. Here the summary version, the minister with the consent of the Commissioner General may specify additional classes of person required to register. If minister asks custom commissioners also should be have to have a tax file, then minister can do that part. Then the Commissioner General shall register any person if they willing to do so. Commissioner General has power. If Commissioner General feel the Japanese student who is earning more than this 250,000 or something, that they can ask them to register. You have to have a file. Then they can do the registration. Then if the capital gain tax one, here the Commissioner General refused to register, such decision could be communicated within 14 days. That refuse to register mean you apply for the registration, you want to have tax file, but you don't have income, you go there and apply for the tax file. But then department say that you don't have that much of income, you don't need to special register. Then that communication need to communicate to that person within 14 days with the reason. So then the capital gain tax return is, you know what it is. Basically capital gain, every person of taxable income consists in gain from the realization of investment asset shall file the capital gain tax return not later than this one we discussed, not later than 1 month after the date of realization, after the not later than 1 month after the sale of that capital asset. Then here, failure to notice to required filing. This is also one of the things, this is not very much important. Notice to required filing is 1V form. If you have heard of 1V form, the person who are not in the tax net, but Commissioner General thinks that they also have to have a file. They ask to fill the 1V form. 1V form means basically they are asset detail and the revenue income detail, bank account, so on and so. Then they can request that detail and furnish that kind of return. Then within 14 days, the minimum date is the Commissioner General can't ask kind of here, if you can see, Commissioner General can't ask within 1 month you need to fill this one and send it. Commissioner General must give minimum at least 14 days to complete this one. Then most probably they are giving 1 month basically. In practice, they are giving 1 month from the date of notice or the serve of notice that received of that notice. 1 month they are giving anyway. Then the practically, here the law says 14 days. Then the information when we are furnishing the return, information perspective, what are the information you are submitting together with the return? Then the withholding certificate information is specified by the CGIR, not specifically specified, but in the return, if anyone can tell me what are the document they are requesting together with the return? Anyone can tell me other than withholding certificate? Income tax return, they are requesting few detail together with the income tax return. Can anyone tell me what are the others? Withholding tax, definitely they will request. Even now in practice, they don't request withholding tax certificate. They request in withholding tax schedule. Schedule is they will cross check with other party schedule, and if it is there, then they will match those detail and verify, and they will grant a credit. Because in practically most of the company is facing these difficulties. Previously, bank were deducting withholding tax now. Then the company claim tax credit. Then the company file the return together with the schedule and the certificate also they have attached. Then but bank has not declared that withholding tax in the return and schedule. Bank has not properly declared. So then the department refused to give that credit. Then what the final outcome was, they issue assessment. And finally that assessment they have to reply and sort it out with the bank, and bank they need to ask to bank whether they need to submit and whether they have submitted that schedule properly, and they need to remind properly submit this detail including our company withholding tax detail. Then so many of plenty of work. But under new proposal, since withholding tax remove, the interest income they have to pay taxes on their own. Then whatever the income you are depositing in the bank, they will not deduct any interest. Then what you need to do is you need to consider that one as a assessable income, even individual and the company also. It was not a final for company. So then the company anyway they have to consider that no credits, and it is easy for them without any last moment hassle. So I didn't get any the same slide, right? What are the document, right? If you can see here, this is the return of income for the year of assessment 1920. They requested the below 12 item together with the return in the year of assessment 1920. If you go through with the year of assessment 1920 return in the online form, so you can realize auditor's opinion, they request in investment income statement, balance sheet, cash flow, equity note, basically your debit account, right? And the tax computation. Because we can't attach as a one, we need to separate those things and separately attach one by one. We can't attach exactly as a one file. That is why they have mentioned those things separately. Then the policies and notes, detailed P&L, the notional tax credit under previous law. Then the transfer price and disclosure form is one of major critical one. Then the other document is applicable. What are the other document? Basically, payment slips and any other meeting minutes with IRD and so and so. Then the withholding tax credits schedule, basically schedule, not the certificate. Certificate is required or submitted when they are required, especially when they are conducting audit or any other thing, right? Here the major part of the session, one of area, the assessment. Assessment is what? Basically, you can make assessment or the department can make assessment. Assessment is taxero. So then you are assessing your tax liability and the department also can assess your tax liability. If you are not assessing, department will assess. So both way, right? Both way is there. Then the one way is you are assessing, other way is another department is assessing. The self-assessment is what? Basically, you are assessing your assessment because this is you submitted the self-assessment is November 30th. November 30th. November 30th is the self-assessment you filed, right? The return, income tax return. The default assessment is what? If you not file the assessment, department will issue a assessment. Then the default assessment. The advanced assessment is what? Before you are filing November 30th, if department come across this kind of situation where you are going to department think that you are going to migrate. If a company going to some kind of directors or basically it is coming to the individual perspective, advanced assessment, basically the company point of view, definitely they are there. Here no, then the some project company in non-resident, they that kind of arrangement is there. They are going without closing properly. The foreign company, maybe Chinese company or some other company, they are not properly closing and not properly settling tax, and they did the project and go. They did the project and went. So that kind of things also there. The individual perspective, advanced assessment is basically before you are submitting the assessment. So self-assessment. I will explain the whiteboard as well. Amended or additional assessment is whatever the assessment they raise or you raise, you can amend or the department people can amend. So we'll quickly run through with the detail and we'll have a whiteboard summary as well. Taxpayer who filed the self-assessment return, including nil return, treated as self-assessment. They return November 30th submitting that one. Self-assessment taxpayer who has filed proper return and declared loss is treated as he has an assessment on amount of loss declared in the return. The loss you can declare in the return, that one is subject to an assessment. They need to verify, department people need to verify that loss, whether it is correct or wrong, right? The tax return complied with and filed in the return in writing or electronically shall be a self-assessment return despite of the following. Then the you are filing in writing, maybe the electronically. Online option is also there. RAMIS. To RAMIS, you can submit the return. Then the form included pre-filled information CGIR, tax payment computed electronically, information insert to the form. Those things are detailed, return, what we discuss in the, whatever the additional information also we discuss in the previous slide. So the default assessment also, if you can refer section 133, default assessment is what we discuss is here the action verb is fail to file. Taxpayer is failed to file the return. Then the assistant commissioner, with her judgment, they will make a default assessment. Assistant commissioner make a default assessment. Then in that assessment, they will declare the tax amount assessed, penalty, because they have not make the payment and not file the return, and the late payment interest and the tax period they need to declare in the notice of assessment, and the date for the above payment not later than 30 days from the date of service notice. Then the manner of objecting. How to object this one? How to object is, if you want to reject, if you dissatisfy this assessment, how to reject? Within 30 days, we need to appeal. That one also they have required to state in the assessment itself. If you can see the assessment, those details are there. If you have seen this kind of assessment. So here the same thing, the default assessment, these detail, the service of notice of the default assessment shall not change the original due to payment and penalty and interest are applicable. Default assessment is applicable only the tax collected by the assessment. See, the default assessment may be made at any time. Anytime they can make, because they have not filed the return. So the issuing default assessment, taxpayer shall not relieved from being required to file a tax return which the assessment serve. Then the taxpayer will get the return filed by a taxpayer after the default assessment served, not be a self-assessment return, because the taxpayer can, after receiving the default assessment, because taxpayer initially November or no before November 30th, they don't have file a return. They didn't file a return. Then later department issue a default assessment. Later, they issue a default assessment. So after that, taxpayer can again file a return. Then that one is not treated as a self-assessment. Shall not be a self-assessment because it is based on the default assessment. Then the advanced assessment is what we discuss. Advanced assessment is maybe issue an advanced assessment in with evidence available with he or him as tax paid, because what I explained is advanced assessment. The basic thing is one of the big person who going to migrate from Sri Lanka, department got to know, and they in advance issue a assessment to file the return while paying this much of amount, right? This kind of arrangement we call it as advance assessment. The assessment means return, right? Advance, whatever the tax liability assessment, right? Department will say the advance assessment, advance tax liability. They will calculate this kind of assessment amount and ask them to pay. So advance assessment is applicable only when the no return is furnished the taxpayer for that period. It is before the return filing due date. Anyway, November 30th, before the November 30th. Then tax is collected by the assessment, basically. Then the only when the tax is collected on the through the assessment, because that person is migrating from Sri Lanka, then we need to collect through the assessment. The advance assessment should be made before the taxpayer's return due for the period, exactly before the November 30th. Then the shall be made in term of the laws prevail at that time. Then the as per the sections, according to the section as amended. If there are any amendment, they need to apply the rate accordingly. If it is they are doing manufacturing 18%, whatever the rate newly introduced, those things also need to consider. Then the same thing, the default assessment, advanced assessment also, these things the assistant commissioner need to include when they are issuing assessment. Then the amended assessment. Amended assessment is one of the area that you need to focus. Advanced or amended assessment. Sorry, amended or additional assessment. Here, section 135, the assistant commissioner may amend a tax assessment, there may be self-assessment, by doing the alteration to the additions based on the evidence she may be available to best of his knowledge. Judgment. The original assessment of the taxpayer for the period, the ensuring that the assistant commissioner is amend the assessment by doing the alteration is the keyword, right? Then ensure that taxpayer is assessed correct amount or loss carried forward for the tax period. Then the whether the correct amount they have declared, because taxpayer might declare 100, but the department assistant commissioner got to know it should be 120. Then they can do the amended assessment. In other case, the taxpayer is liable in order to taxpayer is liable for the correct tax payable. Is the what I said. In other cases, taxpayer is liable for the correct tax payable in order to get the correct amount. Here the loss, correct amount of loss carried forward. Here the correct amount of tax payable. Here originally taxpayer said 100, but assessor said it should be 120. Assessment issued to 20, pay the 20. Right? Then here the time bar is one of again important area. The time bar of the assessment. Time bar is what? Time bar is the limit to have department people to argue, right? I will explain the whiteboard the time bar as well. Time bar is basically here the important time bar rule I will explain. Two important rule. I will clear this one. The time bar is kind of line. Here, if you can see, your year of assessment is this date. Right? Here, the year of assessment is this date. Year of assessment, let's say year of assessment 2019-20. Then what you need to do is the time bar in order to this year of assessment 1920, you need to aware that the amount, the date, number of days the department people is having to issue assessment, right? If you file the return on due date, when is the amount is due, right? When the department people can issue, till when department can issue, people can issue the assessment. So we call it as time bar. After that, they can't do any assessment. They can't issue any assessment. Then I will explain this one. No worries. This is the year of assessment, and they filed the return on this date. They filed the return 30th. They filed the return. Let's say November 30th. November 30th, they filed the return for the year of assessment 1920. November 30th, 2020. Then what you need to do is, then you file the return on or before the due date. Then in the department can issue assessment. Department can issue assessment till when? Within 30 months. Within 30 months. They can issue assessment within after the 30 months from the filing of the return. The filing of the return. After 30 months from the filing of the return. Then this is, let's say the filing date is November 30th. Then they can issue assessment from this date to this 30 month. 30 month, 30 months. Then the November 30th, they file the return. They file the return November 30th. CIT return. We call it as income tax return. Income tax return November 30th. November 30th. Then they file, and within that, with that date, from the date of filing return, from the date of 30 months. Then the what? Then the during this period only department people can issue assessment. Department officers can issue assessment. After that, time bar start. They can't issue assessment. During this period only, they can issue assessment. Right? I will draw this one with a red color. During this period, they can issue a assessment. Right? During this period, IRD can assessment. Right? Assessment. After this, when is the last date? 30 months. Can you count down the 30-month count up? 30 month. When is the last date? Yes, May 30th, 2023. Is he correct? May 30th. The last date is, I will put May 30th, 2023. 30 months. Basically, two and half year. 2.5 year. November 30th, 2020 November 30th, 2021 November 30th is 1 year. 2022 November 30th is 2 year. Then the 6 month is May 30th, 2023. Yes, this is correct, right? May 30th, 2023. Then after that, IRD cannot issue an assessment. After that, here department people, the IRD officers, this is not this color. This is their enjoyable time. They can enjoy during this period. Taxpayer, they can give 20, 32 වද 32. So they can give during this 30 months only. Then later, during up to when, after that, they cannot issue a assessment. This is, we call it as time bar start. Time bar. Now, time bar. We call it as time bar. Time barred. Right? start. Time by start. So then they can't issue assessment. So this is the method. Then assume that they have filed the return October 30th. Then when the last date for issuing time bar, October 30th, they have filed. Can anyone tell me if they have filed the return on October 30th? What is the last date? Department can issue assessment. October 30th they file. October 30th they file the return. No, it is not correct. Yes, one answer I got correct. It is should be April 30th. 30 months should be from the date of filing the return. If the date they file is October 30th, then if it is October 30th, then from the October 30th 30 months. Then that's what I need to explain to you. If you are filing in advance, you are getting benefited. Then the department is extending time. Currently, this due to COVID situation, if they are going to extend the time, then the time bar also will be differ till 30 months. Let's say due to this COVID situation, you file the return, let's say somewhere here, January or February 2028, then the time bar goes up to here, right? Then the department people, you submitted, let's say you submitted the return. It is the worst case scenario, submitted of January 30th. Due to this COVID situation, you got excuse from yourself and you file the return January 30th. Then the department officers also having 30 months from the date you file. Then they also have enjoyable time to punish you, 32 other. So then they can also enjoy the 30 months from the date you file. Therefore, don't let them to punish you. Then try to file the return at your earliest. If you not file the return, then no, if you file the return September, then time bar start from this date. Then until such time department people can issue assessment. Right? This is what I want you to highlight, the important area. Keep it in mind. I will move to the slide again. Then I wait in this whiteboard here. If it is willfully evasion, negligence or willful evasion, then you willfully declare the lower amount. Here I shared this screen. The fraud or willful negligence by on behalf of taxpayer or taxpayer, maybe consultant, maybe tax consultant or the taxpayer, willfully or fraudulently they made return filed with the less amount, then the time bar is not applicable. Any time, no limitation. 30 months is no more applicable. They can go beyond whatever the period they want. Right? 10, 20, 11, 15, 20, 100 years even. If it is willful evasion. Right? No time limit. Then if the return is filed on due date 30 months. In the case of return is not filed on the due date, If you are not filed on or before the due date, in the case of where the self-assessment return is filed, here the not file is on or before the due date. This one need to be changed because if you file the later date, also the 31 is there. Don't refer this column. This you take these two whatever we discuss in the whiteboard, right? This is should be changed as amendment. Amendment perspective, if you are amend the return, it should be 4 years. The time bar start from the 4 years. If you, because then the better to not to amend the return once you submit, right? Not to amend the return. Here should be changed as amendment. Yes, and then the appeal procedure. After that, we are finished, right? We have few slides. We'll go quickly. Appeal procedure is soon after you receive the assessment, what you need to do. What you need to do soon after receive the assessment. So what you need to do is, if you're dissatisfied with the assessment, because you just think you initially submitted 100, but assessor said it should be 120, but you are not agree this 120. You are not agree. So then in that case, what you need to do is 120. If you dissatisfied, you are not agree to pay this balance 20. If you are not agree to pay this 20, what you can do is you can appeal. It is a right, right to taxpayer. You can appeal even if you not aware about technical point as in the law. You can ask authorized representative to appeal. This is authorized representative mean chartered accountant, maybe lawyer, or whatever the person. You can refer the section 195 who are the authorized representative we discuss, right? Then the how the appeal procedure is goes like this. If the request is an objection against the assessment, means in the absence of the return, see the wording, in the absence of the return, then you are going to appeal because you have not filed the return on due date. Then you have to file the return together with the return. You need to send with the return. Then if you not file the return, you got the default assessment, then you need to submit the assessment together with the return, right? A request for review must be paid. The second bullet point, a request for review must be made the Commissioner General. Then you can request, you can appeal, basically request in the sense appeal. Appeal, you need to in writing or maybe electronically. Now it is on electronically as well. Electronically, not later than 30 days. Not later than 30 days. Not later than 30 days. Taxpayer who notified the decision. Then the 30 days is the from the date of, basically we are taking from the date of assessment. But due to this COVID situation, maybe you are getting little late. Then basically what we go was in practice, whatever the stamp, postal stamp date is black round seal, whatever the postal mark, right? That date, from that date we can count 30 days. This is came through the case law, because you can go that method as well, because normally department when they issue assessment, they will, if it is 10th floor, they issue assessment in 10th floor, then the postal department is ground floor, they will get, it will take 1 week to get down the staircase, that letters, right? So then it 1 week is gone. Then again postal department take another 1 week. 2 weeks is gone. 2 weeks are gone. Then when you receive, you don't have enough time to appeal. Then you need to gather the information, appeal last year detail, last or previous year, even 1 year back, because 30 months is 2 years, 2.5 years. Then you can go those detail and you don't have enough time. Then what you can do is post whatever the registered post date, that is the date. From that date you can go. Not the date you company seal. Company, the security officer normally they are putting the seal once they receive, not that date. Not that date, whatever the postal department date. Then there is some concession also. If any cases where the person couldn't appeal within 30 days in the absence of Sri Lanka, he may be some other country and due to lockdown they can't come back, then they can't appeal individuals. So the sickness or critical illness, he hospitalized, he can't appeal. Those things also department will consider and will not strictly monitor the 30 days, but you need to justify the reason properly. Otherwise, the 30 days is required. If you not appeal within 30 days, what happened? If you not appeal within 30 days, what is the scenario? What will happen? The assessment treated as final, definitely you will need to pay this 20. Assessment will be the final, right? Definitely you have to pay this 20. And the practical scenario, due to this COVID situation, they will not strictly monitor this due dates, but for your academic perspective, you need to strictly go through with the legal provisions. So the request must be specified in detail. Request must be specified in detail. Then the grounds of appeal is must. Grounds of appeal is must, right? Then the Commissioner General must acknowledge within 30 days. Commissioner General will acknowledge basically, but if the Commissioner General acknowledge the date of submission, the chop sale date, we can consider as acknowledgement, right? That one we discuss. Commissioner General notify the taxpayer in writing the decision and the reason for his decision. Normally, Commissioner General consider taxpayer request and notify taxpayer in writing. Commissioner General will give the determination in writing, decision, reason for the decision, including reason. Tax official. Then the next bullet point, the tax official, after the tax official who made the assessment, the decision should consider the taxpayer's request. The tax official other than the tax official who made an assessment. Normally, assessment issue of one person, but the here in perspective, they have separate unit. In practically, they have tax appeal unit. Appeal unit is separate unit. The assessment might be issued the person who handling the file. That person will issue assessment, but appeal is goes to another division, which is tax appeal unit. Appeal unit. Those people are here in the appeal individually, independently, and but they are taking anyway the department side. So in practice, so then we need to properly justify the grounds of the appeal in order to win our scenario. If you are not really want to pay this 20 million, if initially you paid 100, the assessment issued the department officer 220. Whether you are going to pay this 20 or not, you need to properly justify why you are not paying this 20. CGIR should make a decision, confirming the assessment, make the amended assessment, additional assessment, or take in the action in give effect that decision. Commissioner General totally has power to do the finality, because he can increase this 20 million or decrease this 20 million. Even he can cancel the assessment. He can cancel the assessment even. So those things, the Commissioner General having powers that they can additional assessment, making additional amended or additional assessment, confirm the assessment. This 20 anyway taxpayer need to pay. Or Commissioner General increase this one or reduce this one. Commissioner General has power. If no request made within 30 days from the administrative review, assessment is treated as final. If you not appeal within 30 days, assessment is treated as final. If you not appeal within 30 days, not appeal within 30 days, assessment is treated as final. Anyway, then you have to pay this 20 million. No excuses. Then the 30 days is must, right? For legal perspective, due to this practical situation, COVID situation, it is, there are some excuses, but in the practice, in the normal circumstances, it is must 30 days, right? Then if an assessment is treated as final, taxpayer timely file the amended return with the approval of the Commissioner General. Filing the amended return has the effect of revising the assessment. Then he can file the amended return if the tax shown in the amended return exceed the tax asset. Then if the amended return, if it is exceed the tax asset, if he can make the assessment, if it is 130, he can file an amended return if tax shown in the assessment exceed the tax asset. Then if it is exceed, he can make the amended return. Otherwise, no need. Right here, the last part of the session, the penalty. Penalty is basically taxing default and penalty thereon. You need to clearly identify penalty in case of failure to pay. Failure to pay full or part, all or part on the installment. Here the critical wording is installment. Installment within 14 days of the due date. Within 14 days of the due date. Then the 10% is the penalty. Then when they are accruing penalty. When they are accruing penalty. When they are accruing penalty. Then if the installment is what? What kind of installment? Basically here quarterly installment. Quarterly installment. Quarterly installment. Right? In the case of other taxes, quarterly installment 10%. Other taxes, pay taxes due for the tax period. Other taxes, pay tax due, maybe other taxes, withholding tax, maybe any other taxes related to income tax law, not the installment payment. Within 14 days, as per the notice of assessment, here even the assessment 20%, including assessments, right? The 20%. Here the 20%. The 10% is quarterly payment, other one is 20%. Then the 14 days is there. Here I have not touched the interest. Let me share the interest as well. It was there in this guide as well. I will explain the interest part through this. Even the self-assessment return also same. Self-assessment return also treating as a return. Right here. interest, if you can refer section 159, interest in the event of default and installment or part thereof, 1.5% interest per month or part of the month could be charged on the default of the installment part or part of the installment. Here the installment perspective and even other one also the same. Here the installment payment 10% because here we are in the installment payment, the income tax. Here the 10% is the tax on the tax amount penalty, and again additionally 1.5% interest. 1.5% interest. Here even who person failed to pay or part of the installment, then the interest also you need to keep it your mind. So this part also I will include into the slide before I sharing. According to the section 150, if you can refer the section 159, 179 is for 179 is for penalty and interest 159. It is easy to remember. 159 for interest. Then the here in the case of 1.5 for the installment payment, the rate is yes 1.5. Here you can edit this installment also. I will adjust accordingly. Right, installment payment. Then let me share the whiteboard in order to explain this. I want to quickly explain. Let me clean this one. The payment, right? Here, if you can see the payment, right? Then let's say you are in quarter one, right? Here you are in quarter one. Then the April to June, April, May, June quarter, you are required to make the payment. You are required to make the payment on or before August 15. August 15 is the due date. August 15. You know that August 15 is the due date. Then what was done is actual date you paid is actual date you paid is not the August 15, not the August 15, right? You paid it August 25. August 25. This is for income tax, right? Not any other taxes. August 25. How much is the tax penalty? How much is the tax? Let's say here the tax amount is 100 million. Here let's say 100 million is the amount, tax amount, quarter amount, right? Not the full year. This quarter 100 million, next quarter 100 million, altogether 400, right? For this quarter, let's say 100 million for easiness, for easier us to calculate, right? Then what is the penalty and interest? Penalty and interest how much? Can anyone tell me how much is the penalty and how much is the interest? Do they liable to pay penalty? Penalty is 10%, interest is 10 million, interest is 1.5 million. Yes. I just want you to correct, now you are learning. Here, that's what I want, answer was correct because not the case, the due date, all or part of the installment within 14 days from the due date. Within 14 days from the due date, 10% of the tax due. Then the 14 days, they have another 14 days. Failure to pay. If you can refer the section 179, let me share the act itself. Act itself. So 179. Here 179. If you can refer, any person fail to pay full or part of the installment on that within 14 days from the due date of the due date. Within 14 days of the due date, then the 10% penalty. 10% penalty. Then do they liable to pay 10%? Do they liable to? No. No penalty, only the interest. Interest is 159. Let's go to 159 as well. 159 interest. Interest in the case of 1.5% per month or part of the month compounding monthly, right? Here compounding monthly, and in that case you can see here I am highlighting 1.5% per month or compounding monthly, right? Interest for the payment under section 158 shall be computed 0.5% of the month compounding. Here referring to the section, here the 0.5% also they are 0.5% and the 0.5% and the 1.5%. 1.5% they are taking from us if we couldn't pay on due date. But 0.5% is what? 0.5% is department pays if we overpaid tax to the department. This is 0.5. Here this is 1.5%. Here 1.5. Here the section 58, if you can see, the Commissioner General require refund in the case of interest. The refund in the case of refund on the interest amount. Then the 158, the Commissioner General under that, here the 157 is for us. 157 interest for underpayment. Interest for underpayment. Interest for refundable amount is 158. 157 is interest for underpayment. We paid lower than the proper amount. In that case, not paid by the due date, not paid by the due date, liable for interest on the amount from the due date. Very important. Liable for interest. Here the very important part, from the due date. Interest is from the due date. Interest is from the due date. Here, because now is slide completed because I explained interest part in the act itself. So then the interest is from the due date. Now, whatever the things we discuss in the whiteboard, interest is liable. Interest is required to calculate from the due date. From interest required to calculate from the due date. Interest from the due date. Interest from the due date. Right? Okay. 1.5%. Not the 0.5%, it is for IRD, refund perspective, right? 1.5%, that is 1.5 million interest we need to pay. But 10% penalty, we can go 10% penalty, we can go more than another 14 days. We can go another 14 days. Interest is calculated immediately. Penalty is calculating after the 14 days. Interest with immediate effect. Penalty is required to calculate. After the 14 days. After the 14 days. After the 14 days, 10% penalty. It is 10 million. Let's say if the person is paying after 14 days, then after 14 days, the date is, let's say, when is the date? August 15 is the due date. August 15, from the August 15, August 25, 10 days, August 29. After that, let's say they paid August, not August, September 5th. They paid, let's say, September 5th. Interest is compounding monthly. Then the penalty is compounding after 14 days. Then you got to know, then there is additional 14 days from the due date, right? There is additional 14 days you can make without penalty, but you need to pay interest. It is higher amount, 1.5 million they need to pay from the due date after the due date, right? In order to avoid the interest, you need to pay on or before the due date, but you can still enjoy the another 14 days if you allow okay to interest, then you can again wait another 14 days to make the payment. So that one is up to you, but better to comply with on or before the due date, statutory due date. Then the penalty is going to calculate is not required, no need to in your level, because department people anyway going to calculate the penalty and all, because it is easy for you, you can do the calculation part as well, but it is not necessary. But the legal provision is the and apply in the case. The examiner might give the case by giving the scenario, they have made the payment, they justify whether they require to pay interest and penalty both. You need to say they are not liable to pay penalty, they are liable to pay only interest. So likewise, you need to justify, right? They give the advice properly. So is it clear? Right. Here 20% is other cases, installment payment, not the installment, other than installment. Right. Then return, if you unable to, if you are unable to file the return, if you failure to furnish a return on due date, the penalty is as per the section 178. Then the section 128 says 5% of the tax owed. 5% of the tax owed. Let's say 5% is how much? And the 1% of the tax liability for each month. Each month. Then the 5% plus 1%. And the here and here see the wording and 50,000 plus 10,000 for each month or part thereof. However, maximum penalty may be 400,000 failure to furnish return. Then the don't take in this exclusion the due date. I will explain that one as in the whiteboard as well. Due to this COVID situation, they are anyway extending the time, but without considering that, I will explain this penalty through the calculation. It is easy for you to understand. Here, your year of assessment. Year of assessment 2019-20. Then the return is due. Return is due November 30th. Statutory deadline is November 30th. November 30th. But unfortunately, you couldn't file this one in December 30th, and January 30th you file. January 15, let's say January 15 you file. January 15 you file this one. But as a black, you file it this one in January 15. January 15, 2021. You file. Then how much would be the penalty? Then the return was due for this period, date. But they submitted the return, they submit the return, IT return, they submit the IT return in this date, the January 15. Then the penalty for late filing, how much? IT return. Then the December 30th, January 15, 45 days. So 1.5 months almost, right? Then how they are going to pay penalties? Let's say tax liability is 100 million. For easiness, let's say tax liability is 100 million. I will just calculate for you to understand the concept. Otherwise, it is just, if you can explain this one, that's okay. Then the 100 million, and then the here as per the section 178, 5% of the tax liability, 5% of the tax liability, and the 1% of the tax liability each month. Here the 5% of the tax liability for the delay, right? For the delay, and this is November 30th to December 30th, basically. December 30th. And here is 5 million. 5 million. Right? And then again part of the month. Again it says and further 1% of tax owing for each month or part of the month. Another, this is for December. This is for December, we call for the 1 month period. And then here you can say January 1st to January 15th, part of the month. Here 100 million into 1%. Here 1 million, right? Here January 1st to December 1st to December 31st, we'll say first month. Then all together how much? 6 million. 6 million. And it says and not only that, and not only that, then again it says 50,000 and another 10,000. 50,000 is per month. 50,000 and another 10,000 for each. It also say in the section 178, 50,000 plus further 10,000 rupees, for each month or part of the during the month failure to files continues. The 178 says. Then December 1st to December 31st, we know that it is again 50,000. And here we know that 50,000. And again Jan 1st to Jan 15, again 10,000. Altogether 60,000. But the law says, however, maximum penalty is limited to 400,000. However, may they come, you can include total altogether 660, and then however maximum penalty however maximum penalty is limited to 400. Then this person should pay how much? Is it 400 or 60,000 plus 6 million? It is 400,000. 400,000 penalty if you fail to furnish on due date. The extension, it is not for applicable for this. Then we are almost complete all the administrative part as well. If you have any question, you can raise. Otherwise, the paper structure, I will share with you what are the paper structure later. And this is the theoretical part up to now we covered. Then you can raise any question through that group as well. You can email or call or WhatsApp me. Then I will help you any unclear areas if you have for the time being. Today we are finished. If you don't have any question, we will share the paper structure, how it goes, and a little later. Um, Thank you.